Hey there, in this video we will talk about exercise and assignment. When you exercise a call option, you can buy shares at the strike price, and with a put option you can sell shares at the strike price. The value of the option depends on the factors like time, stock volatility, and proximity to the strike price. Option assignment occurs when someone exercises an option, potentially resulting in a positive or negative share position for the seller. Alright, let's jump right in and be sure to subscribe and like our video. If you buy an option, you have the right to either use it or not use it. If you decide to use it, you can buy or sell a stock at a specific price that was agreed upon when you bought the option. This is called exercising the option. If you own a call option and decide to exercise it, you can buy 100 shares of the stock at the price that it was agreed upon in the option contract. If you own a put option and decide to exercise it, you can sell 100 shares of the stock at the price that it was agreed upon in the option contract. The reason why options become more or less valuable is because they give you the ability to buy or sell the stock at a specific price in the future. The value of that ability depends on various factors like how much time is left until the option expires, how volatile the stock price is, and how close the stock price is to the strike price. All these factors can change over time, which is why the value of the option can also change. When someone who owns an option decides to exercise it, someone who sold the same option might be chosen randomly to fulfill the obligation. This means they'll either be assigned a short stock position or sell 100 shares of stock at the strike price, with potentially thousands of traders shorting the same option. This means they'll either be assigned a short stock position or sell 100 shares of stock at the strike price. Potentially thousands of traders shorting the same option might be chosen at random to fulfill the obligation, and they will no longer have the option in their account. If someone who sold a call option gets assigned, it means they have to sell 100 shares of the stock at the strike price to the person who exercised the option. This can result in the short trader having a negative share position, which means they've sold or shorted those shares at the strike price. If someone who sold a put option gets assigned, it means they have to buy 100 shares of the stock at the strike price from the person who exercised the option. This can result in the short trader having a positive share position, which means they've bought those shares at the strike price. When a short trader gets assigned, their option positions is essentially converted into a share position as described above. They now have either a negative or positive share position in the stock, depending on whether they have been assigned from the call or put position. If an option is in the money with a 1 cent or more of intrinsic value, which is the difference between the stock price and the strike price, it will be automatically exercised if held through expiration. If you own the $105 call and it's in the money, you will buy 100 shares at $105 per share, which is the strike price, and will realize a profit from the difference between the current stock price and the strike price, plus any remaining extrinsic value. If you're short the $105 call and it's in the money, you'll be obligated to sell short 100 shares at $105 per share, and it will realize a loss from the difference between the current stock price and the strike price, plus any remaining extrinsic value. If you own the $110 put and it's in the money, you will sell short 100 shares at $110 per share, which is the strike price, and will realize a profit from the difference between the strike price and the current stock price, plus any remaining extrinsic value. If you're short the $110 put and it's in the money, you'll be obligated to buy 100 shares at $110 per share and will realize a loss from the difference between the strike price and the current stock price, plus any remaining extrinsic value.